Welcome to tonight's masterclass on investment clubs. My name is Richard Amoedo. I am one of the co-founders of Investor Next Door Club. Happy to have you on with us in this session. So we're going to be talking about the structure, the investment structure of investment clubs and what it means and why. And maybe you've looked at different things. Maybe you're brand new to the world of investing, or maybe it just scares the heck out of you. I'm going to take away a lot of that fear. I'm going to take away a lot of that confusion. And I want you to know that I do believe that between big firms and government, that it was designed to make it complicated for you to think, oh, I have to go to Wall Street or I have to do this. Nothing against financial professionals. I just want you to know that you've got options in the private market as well as the public markets. And investment clubs is one of those things that makes it accessible for everyone. And that is probably our number one mission, is giving everyday people access and to opportunities that otherwise they would not have access to, either from a lack of knowledge or a lack of capital. We want you to know that there's an on-ramp, there's a starting point for everyone in most stages of life. Right now, if you're 18, you have no money, you have no job, it's going to be kind of challenging. But, you've been working a little bit, doesn't matter. You don't have to be a mega millionaire to start investing and start looking at investment clubs. This is the whole purpose of investment clubs. So it's a little bit briefly about my background. There's a lot of you that are on that I've not had a chance to meet or know nothing about us. Maybe a friend invited you and said, hey, take a look at this masterclass on investment clubs, or maybe they didn't even tell you anything. Well, tonight, like I said, we're talking about investment clubs. How do we make investing accessible for all walks of life? And so my background goes before I got into managing funds or raising capital. My wife and I were in the mortgage industry and spent 4 incredible years, maybe 4.5 years, opened up 4 mortgage offices across the country. It was in one of the heydays of a refi boom. And it was a great learning experience. Learned a lot. But one of the things that I learned the most about that time was actually private money, how to raise private money for private deals, things that were not bankable, things that where an investor, a real estate investor, for example, could not go to a bank and get qualified. It just wasn't possible. Either the property didn't fit inside of their box, or the borrower did not fit inside of their box, and therefore it just wasn't bankable. Well, I met a gentleman at a party one night and he introduced me to the world of private lending, which I knew nothing about. Had an opportunity come my way. And a few days later, and I was like, oh, well, let me introduce you to John. And so I did that, and we got that deal done in a matter of days. It was a deal that he'd been working on for 45 days, bank after bank, telling him no, no, no. But John got it done in like 4 or 5 days. And I got paid on that. And I was like, well, if I could do that once, could I do it twice? And so I started a new line of business with private lending, working with high net worth individuals that had 401ks that they had rolled over from their companies, and they liked taking first lien positions on real estate property for investors. So I was basically their marketing loan origination arm for them. Well, then I was told, hey, why don't you start raising some of your own capital? Well, I started doing that, but there were some rules that I needed to learn. And thank God someone came along and said, hey, you need to learn how to do this properly. And I'm going to send you out to California and you're going to spend a week out there. And when you come back, you're going to be all buttoned up. You're going to have a legit fund. And I said, okay. So I did it. And, since that day, since I did that, it has radically changed my life. Meaning when an opportunity shows up, I never look at something as, oh, that's too much money. What I look at is, one, how much money is needed? Who do I need to be talking to? And then what are the other avenues for that capital? And so it all comes down to resources and relationships on any kind of opportunity. Yes, the opportunity has to be good. It has to be, investable. But at the end of the day, it just comes down to relationships and resources. And there's lots of vehicles that people like myself will use to access capital in the private market so that they're in compliance with the SEC, the Securities and Exchange Commission. A lot of times people will come to me and they'll say, well, I don't need to do anything with the SEC because I'm private. It's like the SEC mostly governs private stuff. It doesn't, the public stuff, there's only like 4,000 or so, publicly traded companies. on the big market boards. There's a lot of other smaller ones on the smaller boards, but there's not that many public companies. There's a lot of private companies that are raising money in various ways, and there's ways to do it properly. I've done a session on how to spot a scam, and that's in one of our other master classes. And our members, we talk about it on an ongoing basis because people get fooled by things and they don't really understand what's a legit investment opportunity. So I spent a lot of time talking about investment structures as well as how to spot a scam. So that's a little bit about my background. And so since that time, I've had two traditional real estate funds doing in excess of $45 million on those acquisitions and exits. And when we were looking at what we were going to do for the next fund, I wanted to find a way that we could create access for all walks of life. See, those other funds only catered to people that were accredited, meaning they either earn individually $200,000 a year or more, or they're married and they have a $300,000 a year or more combined income, or one or combined, they have $1 million net worth, not including their personal residence. Like you can't count the equity. So how do you do that? Well, we looked at crowdfunding and then we looked at investment clubs. And I'd looked at investment clubs over 10 years ago. And the reason why I passed on it was because it was all manual. See, with my other funds, it was all manual also, but it was only managing 10, 15, 20, maybe 25 different investors. That was hard, but it wasn't impossible. When you look at investment clubs, they have 99 people or less in them. So if you look at 99 people managing that from an accounting standpoint, the compliance and the things to go along with that, you need some software. And fortunately, we were able to vet out a company that's done over 400 million with investment clubs. And so we've partnered with them because they become our tech stack, our accounting, and our compliance with the SEC because their in-house counsel is former SEC. So we make sure we cover all the bases because we're not taking chances with you or with us. And so I'm going to give you a background, a little education on what investment clubs are, how they're structured. Listen, there are a lot of people that try to do investment clubs and they do them very, very wrong. And a lot of people get hurt. They do things with malice. And obviously that was set up from the get-go to go that way. We focus on what's going to be sustainable, what's going to be conservative, because most people are investing for the future, which means you want to understand how are you secure in that transaction and all those things. So investment clubs, basically at the end of the day, they provide a level of access and ownership that isn't available any other way. Now, it gives power, freedom, flexibility. Those are the main things that I want you to pay attention to as we go through this. And again, any questions, don't hesitate to drop them in. I will gladly answer anything. There's a 100-year track record with investment clubs. They've been around, used by wealthy families for a long time. Now, sometimes when an investment club gets too big in dollar amounts, what they end up doing is they form a family office. So this roadmap has been around a while. 100 years, more than 100 years being used. SEC has a ton of compliance for it. You've got powered of pooled ownership. See, when you go into a fund, let's say it's a syndication. Maybe you've heard of that. Maybe you haven't, but I'm not going to spend any time on it. It's just basically a private group raising money to go acquire something. You become a limited partner. You have no voting rights. You have no real direct ownership. You're kind of like outside the transaction. And you get certain benefits from it, right? Whether it's distributions, when they sell the property. So you kind of get those rewards, but they're a little diluted because again, you're a limited partner. And then you go to, looking at freedom without the burden. Like you can spread your capital around in investment clubs because they have lower minimums, right? So you are able to own more, you're able to manage less, and it really just becomes an investor's dream. And a lot of times people will tell me, it's like, well, I just want to be an owner. And I'm going to talk about some of the pros and cons of that. Like you want to be a solo owner. Well, it's hard to scale as a solo owner. Most of my partners and peers, they might have a fund or they might be individually invested in different deals, but they are a limited partner or a passive investor in 3 times more opportunities than they're a direct owner on because they can't scale any other way. there's just real benefits when it comes to co-ownership compared to what a solo investor can't get. They can't access the shoulders, the learning, the camaraderie, and all those things because they're a one-man show basically. And one of the reasons why investors love it is because people choose clubs over solo investing because they get the community. It's kind of built in. There's a shared interest. Now, talked about it being a 100-year. SEC is a big part of this. There is so many articles that are written on this, and it's morphed over the decades, over the century. But there's so many active clubs that are out there, and we're just one of them. But it's important that when you're getting yourself around investment clubs or around operators of investment clubs, that you understand what's the underlying current, what's really going on. And some people, they'll invest in things and they have no idea who's behind it. And I think that becomes a big mistake for people. So there's just power when it comes to fractional ownership, right? Because you've got this pooled interest, right? So members join the club, they contribute capital to it based on the bylaws. You have voting rights. There's, capital pools that are pulled together, and there's an understanding of, hey, this club is going to focus on these types of assets. It could say multifamily and storage. It could say, hey, we do asset-based lending and we focus on RV parks. There's a number of things that can be done, but it's all disclosed on the front end before you actually become a club member of that investment club. Now, group members, they get to evaluate. So it's important when you're a limited partner in something, you have no voting rights. But when an opportunity gets presented to an investment club, then that gets underwritten and then that information gets passed on to the club and the club has to vote on it. And there needs to be a majority that votes on that. So if something didn't fit inside the box based upon what you understood that club was going to do, then you have the opportunity to say, no, I'm not supporting that. You also get to vote on when there's a possible refinance or a cash out refi, or there's going to be an exit. You get to have a stake in how that all happens, right? But once you're in the club, it is majority ruled. So you do want to make sure you understand what that club is going to be participating in. When the club will take on ownership, obviously that asset's going to put in a different LLC, but that club owns that LLC, which means they have direct ownership, that they get all of the tax benefits, they get all of the benefits from the cash flow and the profit that come during the period of time that they own that asset and they share it together. Those profits get distributed and they return back to the members. Now, typically, depending on the types of projects, those could start cash flowing within a matter of 3 or 4 months, and then quarterly distributions, and maybe there's some annual distributions that happen on top of that. But then when there's time for an exit, when something's going to get sold off 2, 3, 4 years down the road, then that chunk of capital that comes back that is a gain from it, then it's going to flow back to the members of that club. But if you kind of look at some of the math on this, if someone's going to be a solar investor into a fund, for example, those minimums are going to start at 25,000. And most of my peers, their minimums are 50 to 100,000. So that kind of knocks a lot of people out. But when you look at an entry level for an investment club, you could have a 10-member club that's raising 10,000 minimum, so they got 100,000. Now, 100,000 only gets you so far. You're going to have to leverage that with some debt, but you can be pretty conservative with that and still generate a 14, 16, maybe even 16+% return or more on an annual basis, even in a small club. But you look at a larger club that's going to pursue maybe some commercial opportunities. If you had the same minimum at $10,000 and you had 90 members in it, you're raising approximately $900,000. You can go pick up some decent commercial stuff that's going to appreciate and cash flow very nicely. So it creates options. It's like, have you ever been with 2 or 3 or 4 people and it's like, hey, who wants pizza tonight, right? Well, it's like, I'm not going to eat a whole pie, but I'm going to have one slice or I'm going to have 2 slices. That's all you're doing with an investment club. You're just slicing it up like a pizza pie, and sometimes with a pizza pie, I was born in New York, but I was raised here in Texas. Every now and again, I'll tell the pizza shop here, it's like, hey, go ahead and double cut that. Because sometimes it's really big, right? And it's like, I don't want to eat these big fat slices. So just go ahead and double cut it and let's get more slices out of that pie because that way we can spread it out to more people. That's how you have to think about it. But the real thing is that you have real ownership. And people have been doing fractional ownership for a long time, but the word itself for some people is a little confusing because they're so accustomed that they have to have 100% ownership to get all the benefits. But keep in mind when you do that, it's really hard to scale. And also you carry a lot more responsibility. And if you've got a day job or if you've got a business, you may not have the bandwidth for that. So investment clubs create that access point to where you can actually, do that a little bit easier. So that's why we talk a lot about the freedom without the burden, right? When we start looking at owning more and managing less, if you look at a solo owner, they got to have the full capital requirement. They got to fund it alone. They take all the risk. Then they got the tenant management, maintenance calls. No one wants to get a call about a toilet overflowing. You want to have a property management for that. But if you got a small property, guess what? You're getting the call most likely. All the legal liability sits entirely on you. The vacancies hit your pocket directly. The research, the vetting, the due diligence. Somebody was saying, "Hey, can you just kind of teach me your underwriting?" And I'm like, "Okay." There's, 250 points that we're going to review before we move something forward, most likely. You can kind of do something on the back of a napkin and kind of run some basic numbers. But when it gets down to the nitty gritty on how is this thing going to perform over 24, 36, 48 months, etc., then you've got a pretty dynamic spreadsheet that you're working with some pretty smart people. And we're not talking about just pumping this into AI and calling it done. No, we can't do that. When you're signing on the dotted line, you got to make sure somebody fully understands what's involved with those operations and that revenue model and the real exit plan for it. When you're looking at an investment club, you've got fractional capital, that you contribute and others are contributing. Can't be more than 99 people in that club. You've got professional management that's handling the property, that's handling the accounting, that's handling the compliance, all the legalities associated with it. And then you've got distributions across the club structure. So you could, let's say the minimum's 10,000 to get in a club, and we're actually going to have some that are less than 10,000, just so you know, because we want to create those opportunities for people to get their skin in the game, get a real stake of ownership, or expand their ownership ability. But you start, you got a minimum of 10,000. Well, someone could come in at the 20,000 level. That just means they have a little bit bigger piece of the pie because it's all based on the total capital raised to the club. It's not based on units. It's not based on shares. It's based on capital contributed, and then that gets distributed proportionately. So it is the fairest situation that you could possibly have. The risk is shared. Obviously, no one goes into a deal thinking, oh, it could go bad. Well, I mean, you can have highs and lows with something going on, which is why we try to factor out a long-term plan because it gives us time to make adjustments. You go into a real estate transaction knowing what your minimum return is going to be over a set period of time. And if the stars line up, if different things happen, then great, you could hit way above that. But you want to be able to go in to where principal is always protected. You know what the cash flow is coming back, and then you know what the strategy is for the exit over a set period of time. And then again, with a club, the group is going to vet the deals together. So you've got this collective intelligence. One person cannot know everything. They'll know a lot, but everyone's got different skill sets. Maybe you're a contractor, some form of tradesman. Maybe you've been involved in real estate. Maybe you've owned, a larger property, whatever it does. It's a blending of people that are brand new and people that are super experienced. And those two worlds come together and it creates an incredible opportunity for a lot of people. Having the passive ownership is just basically where your money can work for you. And people throw around passive investing a lot. And, the way I look at it is there's activity that creates the opportunity. And then from doing that well and managing it well, it does lead to passive gains and that happen passive cash flow. And then at some point in time, there is an exit, which provides a larger lump sum there at the end. But the benefits of co-ownership is really simple. And this is different than just partners because partners, tend to, when you have 3 or 4 or 6 partners in it, they can have different opinions. When you have a club, there's a charter, there's bylaws, And it's kind of like if you join, I don't know, if you join a country club or if you join a gym, they've got a certain way that that club is going to do things, and everyone adheres to that. But at the same token, if the club is doing anything that is not consistent with the bylaws, then all the members have a right to speak up. So every voice has weight and it matters. But six main reasons why investors choose clubs is they get to access bigger deals. If I live here in Frisco, there's a lot of areas north of us that are emerging, right? And if you're not familiar with North Texas, from here to Oklahoma, a lot of things are, the landscape's changing radically. And I've watched acreage prices go up, every quarter, every year. It's just been going up. And one person on their own may not be able to buy an acre of land. Let's say that acre is 100,000, maybe it's 500,000, whatever it might be. But 25 people together could. So the question is, do you want to own 0% of an emerging market, or do you want to be able to own 4% of an emerging market? It's like a franchise team. The Green Bay Packers did this, except they did it with a form of crowdfunding, but the fans got to buy and put money into a team that they love. They get certain perks and privileges and so forth. It's not the same, but people do this because it allows a large group of people to come together to move a big boulder that one person on their own couldn't. And if you're somebody who wants to be able to get a piece of something, then investment clubs actually provide that access to get that piece. So again, there's access to bigger deals, the shared risk, the collective intelligence is huge. You've got the legal structure on your side. There's clarity with it. There's no argument that it works or that it's legal. It's completely backed by regulations. And there's the education that comes in from just being a part of the club, because it's like being able to join the team, right? To pick your favorite professional team. You get to join the team. You get to put the suit on. You even get to go on the field and get in the huddle, except you don't have to be the quarterback that gets crushed every third play, right? You don't have to get smashed into the turf, right? You get to go back to the sidelines and you get to help call plays. But you're on the field, which is different than being a spectator in the stands without the uniform on. So that's probably one of the better ways that I can put it, is just knowing that you have a voice. And that was what really matters for most people, and knowing you have real ownership. So some people love to, say things like this, which is why they love investment clubs, is own a piece of real estate without receiving the 3 a.m. maintenance call. I've gotten those kinds of calls. The $10,000 of mine goes a lot further inside of a club. Most of the time, it actually lets you get into something because, again, most of those minimums, they're going to start at 25,000 or more. And I've met a lot of new accredited people that are just not comfortable. It's like, I've got $35,000 that I could invest, but I don't want to put it all in one deal. So investment clubs allow them to spread it out over 2 or 3 opportunities that otherwise would have been 0 opportunities. And then they finally understand, what they're investing in because they're on the inside. It's like sitting in the boardroom and you're around the board table and you get to make decisions, but the executives and all the other people have to go do the work, right? So you get to be that level of ownership because you actually have a voice and you're not the one having to manage all those things. And you're not just turning your money over to someone for someone else to manage it. So bottom line is you get to have access, you get the community, you get the education, and you get the proper structure. And then when you just look at the other, aspects when it comes to solo investing and club membership, one, you as a solo, full amount, all on you. There's it's limited your personal resources. So scale is hard because banks are going to cap you at a certain point. Everything from management is going to fully be on your shoulders. You got no one else to lean on. And then typically most of the time you're going to be concentrated on one deal or a small amount of deals. And it doesn't create a lot of diversification. I like to have clubs that are diversified. All my funds were diversified. They were never in one single asset. And then just the decision making, right? You've got the research on your side, but you've also got the ability to get that collective intelligence. So the thing I love, most is really going to be the flexibility. Solo, it comes down to all or nothing. But with investment clubs, it really comes down to being able to diversify, spread it out, and be a part of transactions and opportunities that you otherwise wouldn't have been able to have. Now, we're going to have our first club. It's going to open up July 1st. Some of you I know are on tonight are members of our Investor Next Door Club, which is our education community and our community that gets together in person, online, and all those things. So we really are just a group of people that are with a common goal to build and make things happen together that are too big to happen all by yourself, or just because you don't have the bandwidth, right? And then the other thing is our club members, they're not in some high ticket program. A lot of times people don't get into learning about real estate investing or any kind of investing because those entry points again could start at 10, 15, $25,000, and that's just for 1 year access. So what do 97% of the rest of the people do? Nothing until we came along. We created a model that allowed you to get access to the same kind of training. And actually, in most cases, it's better because it's real time and you have a vibrant community that's actually interested in your success. And if you can, we're in the Dallas and North Texas area here in the Colony across the street from Grandscape. If you know what that is, it's Warren Buffett's big retail playground, I like to call it. There's a Ferris wheel there and everything. But across the highway, at the Cascades, we will be doing an in-person event on June 18th. And that's where the community gets together and we go over the overview of everything about Investor Next Door Club. And what I want you to know is you're never going to be pressured to make some kind of investment. We're here to make sure you're educated, to make good decisions for you, your family, and your future. That's our job. I was fortunate to have mentors that pulled me alongside. And then we've obviously spent hundreds of thousands of dollars being in those high ticket programs, as well as investing in the legal and all the things associated that we had to do to run those funds. And I just kept on thinking, how does somebody else get access? Because if I didn't go seek it out and find some good quality people to work with, I may not be here tonight, right? I might be doing something else, or I might have got wiped out on the first deal. I don't know. But I do know that there's a roadmap and a pathway to have success, and we'd love to be on the journey with you. I hope you got value from this. If you ever have a question, do not hesitate to send an email to support@investornextdoorclub.com, and we're happy to respond and answer any of those questions. Until the next time, till the next session or the next in-person event, have a great night, and we look forward to seeing you. Bye for now.